Morning, everyone. We have quite a few people joined us already. Time is ticking over to 11, so we will start now. So welcome to Saturn Advice Webinar today. I'm your host, Joyce, a financial advisor at Saturn Advice. Thank you for taking the time and being here today. I hope you enjoy the next hour. Now, before I introduce our topic and panel speakers, just want to go over some housekeeping stuff first. So we do have a live Q&A today. Therefore, we have enabled the question functionality, which is located at the left-hand side of your screen. Throughout the webinar, if you have any questions, don't be shy. Please pop them in there. We will have about 20 minutes towards the end to answer your questions. We will be recording this webinar. If you want to play back and listen to key points later on, please use the link which will be emailed to you in the coming days. And also the information shared here and opinion expressed are general information only. These are not financial advice. We do encourage you to seek personalized financial advice, which takes into account your unique circumstances. Just making sure that I am not talking to myself and the audience can actually hear us. Could somebody please just pop in the question box that you can actually hear us? Fantastic. Thank you. All right. Okay. So let's get on to the agenda. So the topic today is our listed property funds, good alternative for property investors. This is part 2 of our mini webinar series, navigating tax laws, what are the alternatives. So for those of you who haven't attended the first session, the recording is available on request. Now, let me introduce our wonderful panel speakers. So first up, we have Jean Strock. Jean is a financial advisor and a shareholder at Saturn Advice. Jean has a degree in finance. She has a knack for keeping clients engaged with financial planning by staying relevant and empathetic. We also have with us today Pete Morrissey. Pete joined us from Australia, so it's an early start for him today. Now, Pete is the lead portfolio manager on the APN Australian Real Estate Investment Trust Fund, and he's also CEO of Real Estate Security at APN. Pete has completed a master level academic research paper with Lincoln University, so he's actually from New Zealand and residing in Melbourne. Last but not the least, we have Lisa Dodson. Lisa is a director at Acumen. She is also a director and shareholder of Saturn Portfolio Management Limited. Being an investor, entrepreneur, and seminar speaker, Lisa is one of New Zealand's leading personal wealth educator. Welcome, all 3 of you. Thanks for being here today. And for those of you who just joined us, welcome. Now, without further ado, we'll kick it off. We'll come to you first, Jean. So Jean has actually prepared a presentation for us. I'm just going to bring it up on the screen. And Jean, I will hand over the control to you. Let me know if you want me to drive it.
Thanks, Joyce.
All right. Okay. So my first question to you, Jean, is with the recent change in with the recent tax changes on residential properties, have investors missed the boat with direct property investment?
Thanks, Joyce. Well, it's fair to say that Kiwis are a bit obsessed with property. They love the security of bricks and mortar and the feeling, I think, of being in control of their own investment. And I would include your owner-occupied home as a property investment. So it's really easy for Kiwis to be overexposed to the asset class. The big attraction, of course, has always been the ability to leverage up. So you earn a return on the bank's money and deduct the interest as an expense. But the New Zealand government's made some pretty major interventions in the market in recent years, and they're trying to do several things. Stop the runaway price increases for property, tilt the market to first home buyers, and also give tenants a bit more security. So we covered a lot of these tax changes in our past webinar, but definitely you can still be negatively geared on a property, but you're not allowed to offset the rental loss against your personal income. The LVRs have gone up, and we talked about the changes to the Bright Line test and the loss of deductibility of interest expense in our last webinar. It's early days for these changes, but we've yet to see the property market really subside. The prices are still very high, so there still is obviously interest out there. I would add that residential property is a relatively illiquid investment, that if you want to go on a cruise, you can't just sell the porch of your house. You can, of course, refinance to free up equity, but I find I meet a lot of clients now that are relatively close to retirement, and they often don't have a positive flow from their property. So all of their rental income goes to pay the mortgage, and it's not necessarily going to help them with their countdown shopping when they're retired if they don't have cash flow.
Yep, carry on, Jean.
So other changes the government's made have been the Healthy Homes Act, and those standards came in from July the 4th. Those to provide minimum standards for heating, ventilation and insulation. And as we know, with New Zealand's relatively cold, damp, mouldy houses, this is probably absolutely a good thing. It's interesting to note that Kāinga Ora, or Housing New Zealand, has given itself an additional 2 years to meet these minimum standards. And the other big change in legislation was the Residential Tenancies Amendment Act, which came in last year. And it's making it much harder for landlords to terminate a tenancy, and potentially harder to deal with antisocial tenants. So I think it's made landlords a lot more risk averse about who they'll rent their property to, and it could explain the explosion in emergency housing requirements that we're seeing at the moment.
Yep, absolutely. It's certainly difficult being a landlord right now. Now, just an observation that the Bright Line test and also the removal of interest deductibility don't actually apply to commercial properties. So does it make commercial property investment a good option for investors now, Jean?
So it's true that you don't have those new changes influencing commercial property, but the big issue is that really good quality commercial property is extremely expensive. So it forces private investors down to the lower tiers of property. And those second-tier properties are probably more likely to be untenanted if there's an economic downturn. Again, it's a really undiversified investment, especially if you have a single tenant. And it's a liquid with expensive sale costs. And hopefully Pete will have some more to say about this, but we're seeing a lot of disruption happening in commercial property, especially from COVID, with decreased demand for retail and office properties. So again, an area where you have to get really good advice.
Yep.
Make a comment to me, just so you're aware, we haven't addressed the fact that for new builds, the LVR is still 20% and the interest deductibility is still there for new build properties, although what that looks like at the moment is still under discussion paper. The other comment too with direct property, with direct commercial, is that banks are usually wanting a 15-year P&I, whereas a lot of residential investors are 25, 30-year interest only. And I hear recently that some of the banks are even requiring a 10-year P&I on commercial. So that makes a significant difference on cash flow. I think that a lot of residential investors who may be considering direct commercial may not be aware of.
Yeah. So Well, I mean, and also on the other hand, even if the investors can meet the bank's requirement to borrow, not many investors can actually fork out a few $1 million to purchase a top-notch commercial property. Now, I've heard about syndicated properties. So, Jean, does syndicated property make it more affordable for small investors?
Yes, certainly. You can get access to good quality commercial property at a lower price. Some of these syndicates are have quite complex structures. So again, it's important to get good advice. Often there is still a significant minimum investment, sometimes around $50,000 or so, and often they're only available to wholesale investors. So you don't have the same protections that you would have as a retail investor. Again, illiquidity is a huge problem for syndicated property. Sometimes the syndicate will operate a kind of secondary market and help you sell your share, but this can often be below the actual net asset value of the building. So at Saturn, we don't use syndicated property in our client portfolios because we do aim to get cash back to client bank accounts in 5 to 10 business days. And so syndicated property doesn't fit with our business model. But it's certainly an option for investors if you get very good advice.
Yep. I can see that for investors who need liquidity, syndicated property can pose quite a few challenges there. So are there good property shares available in New Zealand, Jean?
Yes, there are about 8 or so listed property trusts in New Zealand. These are some of the most well-known ones. So Precinct owns the Commercial Bay development down in, right on Auckland's harbour side, and it owns the PwC building and some commercial property in Wellington. Goodman Property Trust own the Highbrook office estate out in South Auckland. So listed property is highly liquid, so you can buy and sell your shares on market. You often have to use the services of a broker, but you can now use low-cost platforms such as Sharesies. And there are a few ETFs for listed properties, so Smart Shares operate one of those. So again, your return is based on dividends and on the capital growth of the property. And in fact, many of these property trusts in New Zealand on the New Zealand market are structured as PI funds, so there can be certain tax advantages too if you're on the top tax rates.
Yep. So given what happened over the last 12 to 18 months, can listed properties also be quite volatile?
They certainly can be. I mean, traditionally listed property was regarded as less volatile than the wider market, but this is the share price of Kiwi Property Group during COVID last year. So Kiwi owns Sylvia Park and Lynn Mall and lots of other retail and office properties. And of course, the malls just were completely closed during COVID. So the Kiwi share price basically halved. The business had to renegotiate all of its banking covenants. All of the top executives took a significant pay cut, and then Kiwi suspended their dividends. So you can see where the share price still isn't back to pre-pandemic levels. So when you're buying direct listed property, it's still worthwhile having a collection so that you've got some diversification. But often it's good to use active managers who are truly experts in putting together a portfolio of listed properties. So again, at Saturn, one of the funds we use is operated by APN, and it's good to have Pete here to talk to us about that. So that gives us exposure to Australian property. We also like to invest in global property because New Zealand and Australia are such a small market. But it'll be certainly interesting to hear Pete's comments about Australian listed property.
Great. Thanks, Jean. Let me just take over the control of presentation and start sharing Pete's presentation. Just give me a couple of seconds. Right. So this is a great segue to Pete's presentation. Now, before I hand it over to Pete, by way of introduction, APN has more than 20 years of experience managing real estate securities. The APN A-REITs fund was actually launched in 2009 in the depths of GFC when the market was recovering. And they see a great opportunity investing in real estate as it is oversold. And the fund has certainly captured that opportunity and generated good return. Now, a famous saying from Mark Twain goes, the history doesn't repeat itself, but often rhymes. And how interesting, here we are now, 18 months after COVID, onset of COVID, does A-REITs again offer opportunity for our investors? Over to you, Pete.
Great, thanks, Joyce, and I pretty much agree with everything that Jean said around residential and commercial. You know, there's a difference there around, really it's the risk profile, you know, and along with the composition of the return. With a residential property, you're going to get lower income, but potentially you may get higher capital growth subject to the way a market's performing, whereas REITs are really collecting rent and passing that rent through to their investors. So the composition of the return is driven by income with a component of capital growth, which generally is smaller. So just a different return profile and risk profile, what you're achieving or receiving from a REIT, and that's going to be enhance a portfolio through diversification. So Joyce, I can't actually see the move forward buttons on mine, so could you just go to the first page? Great. So, you know, as Jean said, New Zealanders love property, and that's one thing I always said to the guys here, that there was a great opportunity to attract New Zealand investors into our fund because they need diversification. But, you know, why wouldn't you want to have New Zealand residential property? You know, best places to live, Auckland and Wellington are in the top 10. They've moved up significantly and due to COVID. But also, house prices in New Zealand are extremely strong. And so this chart looks at where most growth has been, and you can see I've put a pretty significant arrow down to New Zealand. There's been huge house price growth. And so that's fantastic if you're already in the market. And you certainly, I feel that in both in Australia and New Zealand, the big lever to pull was immigration when able for governments as we move through COVID, because immigration has underpinned commercial and residential property in Australia for a long, long time. So that's a lever that will be pulled in the future, which will provide perhaps at least a base where current prices are. There may be some reversion at a point in time, but I feel that's going to be very supportive. So I'm not necessarily saying because of this you're going to move out of residential property, but maybe there's opportunities elsewhere. So first, let's look at what you get. The residential on the left, you know, it's a 1-year lease versus commercial tends to be 5 years or longer. You've got an individual tenant in a house or a residential property versus corporate tenants. So they've significant balance sheets behind them, and there can be, if not dozens, potentially hundreds across a big portfolio that the A-REITs have. So pretty significant. So that, again, it's diversification. You're spreading the risk that, businesses did go broke last year as a result of COVID and probably still are. But the quality of the tenants and the assets that the REITs own, which are the best assets in Australia, are very high. The legal protection, as Jean said, there's a skew that's perhaps even getting more pronounced that is advantageous to the tenant, whereas on the commercial side, it's a lot more balanced. The resi landlord, those costs are borne largely by them, whereas in the commercial side, the tenant picks up most of the costs. So that is a result that underpins the income side. Residential, there's perhaps a more market-based rent reviews, whereas with commercial, you've got a lease that's put in place and it will go up every year, and that's where it can potentially be a good inflation hedge. Inflation hasn't been a discussion point for a long time. I don't know, a few weeks ago it seemed to be at the front of everyone's mind, but a lot of leases out there today have inflation linked, so they'll go up either by a fixed amount, a fixed and CPI or CPI, so it gives you a level of inflation hedge in your rental growth. So as Jean said, commercial property can be really difficult because it's expensive, and buying poorer quality assets, without doubt, I feel there's a risk factor there that some of the office buildings that are B grade in Sydney and Melbourne are going to be the ones where tenants won't want to be anymore. If they're going to be in the CBD with their workforce, they'll want to be in better quality assets that have more flexibility. That's what they're after. So those assets will become they won't be able to compete for tenants, and they'll potentially lose value. And so that's a risk for an investor. You need a lot of specialist management. There's real skill in pulling in the right types of tenants, having the right mix, and dealing with the lease negotiations. Low liquidity, clearly you can't sell a component of a large building, and that's just not feasible. And then diversification. If you put all your money into one commercial asset, which may have half a dozen tenants, and one of those tenants leaves, it can be a significant hit to the cash flow for that asset. So the best way to get a diversified exposure to commercial property, without doubt, is through REITs. So what you get through the REIT is, you don't have to put in a large amount of money. For our funds, it can be $1,000 or less if you're on a payment plan. You've got the liquidity that many investors still want from an investment. It's the same, they trade the same as a share, so T+2, you can have the money back in your account. And I think one of the most important things is the quality of the asset, the quality of the management. Australia is the second oldest REIT market in the world, behind the US. So very high quality, experienced management teams, which are world class. And then the diversification that you get, you can have exposure to office, retail, industrial, plus all the non-core sectors that look like are going to perform extremely well going forward. I'll call out service stations. Did fantastically well last year. It didn't matter how many cars were on the road in Australia. The rent was still being paid because they were open, as they were an essential service. So what is a REIT? Well, you get higher yields, and you'll get off residential property. You will get capital growth. The cost can be low. The low entry threshold, they can be tax effective. Their expert management is key. You can't just expect to buy commercial property and manage it really well. Because there's a level of expertise involved, and bringing in new tenants into a building, that helps if you've got a pool of other assets that you can help with your negotiation. So say what you do in retail as a Westfield shopping centre. So if you own Riccarton and Sylvia Park, you can negotiate with a tenant to get a better outcome. Liquidity and diversification are the other two. So they offer a lot of different things that you can't get from residential. The names, Westfield, Mirvac, Stockland, GPT, Dexus. You would have heard of, no doubt, Westfield, most people, and some of the others. But these are very, very large companies that own large assets that, worth in the values are in the billions of dollars. So the management teams are well experienced and get the best out of the assets. They work them really hard. What you get, for property for income. So I think you've just got to consider that commercial property is a different type of investment to residential. It's primarily investment in an income stream as opposed for more capital growth. It's defensive, so they'll perform much more defensively than the broader equity market. You've got long lease contracts. You're at the top of the credit queue. The tenant quality is really, really high. That's a key thing with the quality of the assets. There's inflation proofing within the portfolio as well due to the lease structure and the fixed rental or CPI growth. And it's predictable, repeatable and sustainable cash flow. So that for us can come through to our investors as a monthly distribution yield, currently at about 5.6%. So it's pretty attractive compared to the yield that you can get from other types of investments, including fixed interest and including residential property. Happy to take a few questions.
Thanks, Pete. I'm just looking at the question box. There are a few questions there, but we will save it for later. Thanks for the presentation. And 5.6% yield certainly sounds a lot than the 0.9% we get in the term deposit. And I think, you know, a lot of some of the listeners on this webinar today is probably hearing REITs for the very first time. And what's better than listening directly from a fund manager? So thank you. Now, last but not the least, we will come to you, Lisa. As a one of the leading personal wealth educator in New Zealand, I'm sure that you talk to all walks of life all day, every day. Now, drawing on your experience with what's going on in the market or the changes that we have, what are you seeing with your clients? What kind of conversation are you having with them now?
Well, I'll take a step back because I think, you know, the conversations that I generally have with my clients are really not so much about watch investments, but more around these are my goals, or I think these are my goals, and how do I get there? So I think that's a really important place to start because, you know, as a financial advisor for, you know, over 25 years, people have always come to me and said, oh, which is the best investment? And I'm like, well, I don't know. Let's start with, you know, what are you actually trying to achieve first? So I think, you know, a lot of the conversations I have around are goals-based around, you know, where are people trying to get to? And then another thing to consider as part of this is what age are you? Because when you're younger, you know, sometimes leveraging into residential property is one of the few ways you can go because you've got an option. Well, if you've got any extra cash of putting it into your mortgage, or potentially you could put it into some REITs and, you know, as I say, that $1,000 a month. For a lot of people, though, they want that security of getting their own mortgage paid down. And one of the only ways they can kind of get started is into residential property, despite, you know, the challenges with increasing of LVRs, you know, bright line tests increasing, interest deductibility on residential that aren't new builds. So I think that as people are getting older, you know, they're in a different position because they've got, you know, their asset base has been built up, and so their goals, requirements change from being growth orientated to income orientated, and I think that's a really fundamental thing that people need to sort of understand. Because even some of my retired clients, they're kind of going, I want to get income, but they're still focused on their residential property because they go, well, I bought it for, you know, a place in Remuera for $100,000 25 years ago, and now it's worth $3 million. How can that not be a fantastic investment? And I'm like, well, it's not that it hasn't been a fantastic investment, but now it's giving you a place in Remuera. It's probably giving you a 1% net return. So, you know, or net income. You know, you're obviously getting the growth, but you're not getting the income. And, you know, like you said, Jen, you can't kind of sell the porch when you want to go on a cruise. So I think that's a thing that people, you know, need to realise is that if income is your driver, then you start looking at the makeup of your investments quite differently. So when we come to all the changes that have been happening in the last couple of years in the residential market in particular, you know, healthy homes in the last couple of years, changes to the RTA Act, and then more recently the tax changes, I think it's made people, because it's been all over the media, and particularly the tax changes have been a bit of a shock. People are going, oh my gosh, you know, maybe I need to, you know, to look at it a bit more deeply than maybe what they would have done in the past. And as a result, particularly again, my older clients, they're going, oh, actually, I'm open now to looking at, you know, more options. Also, too, because the other option that might have been in their head was term deposits, and that's pretty hopeless. So, you know, they're starting to say, well, you know, what else can I be thinking about? And when you start talking about the share market, people go, oh gosh, that's risky. And ironically, you know, when you come from an investment background, you think about risk and you think about buying one residential rental property in one suburb in one, you know, city in one country, and, you know, and as part of the whole world, you think, you know, we go, risk? Are you kidding me? You know, that's high risk because it's, you know, there's no diversification. When you come into REITs and, you know, the broader portfolios, there's a lot of, you know, diversification. It lowers your risk because you're spreading amongst different assets. So, a lot of these conversations I'm having with people is around sort of educating them about what is risk, what does that mean, is liquidity important? When you're younger, liquidity isn't so important. As you get older, liquidity does become a lot more important. And sometimes people don't think about those things. So it's really, I'm having a lot of conversations about education, about what investment makeup is really going to fit their goals, because what may have been ideal 5, 10 years, 20 years ago even, is not necessarily going to be today. And that's the whole thing about financial planning in our life. Just because you have a strategy doesn't necessarily mean it's there for the rest of your life. We have to be constantly thinking about the makeup of our investments and our portfolios and going, is it fit for purpose based on where our goals are currently sitting.
Yep. Super. Thanks, Lisa. It makes a lot of sense. We do have, the webinar that we ran last time combined with this webinar, we talked about many investment options. And there are a lot out there. End of the day, it's about fit for purpose. It's about figuring out where you want to be and what's actually going to get you there. So my next question for you is, what are some of the scenarios or signs that people should that's indicating to people that it's time to look for financial advice, and whom they should seek advice from?
Well, I think the hume is pretty easy from the perspective of looking for a suitably qualified, financial advisor. And it's interesting, because, I talk to, I've got quite a large network of friends and clients, and because I've been in this industry for a long time, so lots of people talk to me about their money. And, even, you kind of think, oh, well, when you're a little bit confused and you don't really know what you're doing, you should seek financial advice. But a lot of the conversations I'm having are also with people that have been very successful investors, particularly successful property investors. And I'm talking to them about different types of things, like, I was mentioning before about income, and they're going, I never thought about that. So regardless of, how well you've done financially and what your knowledge is, you don't know what you don't know. So I think it's always, really good to be having conversations with professionals. And, I'm pretty well educated and I'm a very experienced investor myself, but I still run things past a few people in my network when I'm about to do something new as that sounding board. So I kind of think it, applies to everyone. And because if you think about financial advice, you're paying $300-400 for a consultation, just like you would with an hour with your lawyer or accountant. Why wouldn't you talk to an investment advisor or a financial advisor as a sounding board? What have you actually got to lose at the end of the day? But I do caution people, though, who do try to get financial advice from their lawyers and their accountants, because whilst accountants, obviously, they're very highly trained professionals, they know numbers, they know accounts, but they don't know investments. And so I think, they may be able to give you a small amount of guidance, but I think you really need to be, focusing on a specialist, because so really at the end of the day, I think, always get advice, suss out who the person is and what their experience is. And at the end of the day, what have you got to lose? A few $100s.
Yep. Fantastic. Thanks, Lisa. And thanks to all our panel speakers. I think we should give our audience the opportunity to ask questions now. And as I mentioned before, please don't be shy. Use the question button and pop it in there. So I will now open the floor for our Q&A session. Let me just unshare the slide. Actually, Pete, could you unshare the slide from your end?
Sure, yeah.
Thank you.
I'll try to.
Okay, so great. Yep. So that our audience can get a better view of us. Okay, so I'm just looking at the questions. So we have a question here from Evan Price. So can you explain the difference of protection between wholesale and retail investors?
Well, often wholesale investors, as I say, we actually don't use that differentiation in Saturn. We treat everybody as a retail investor. So the schemes have to be registered with the FMA. For a wholesale investor, you either have to show that you're an experienced investor or that you've got a considerable amount of wealth. But you often sit outside those protections that are offered by the FMA and by certain licensed schemes.
Thanks, Jean. The next question that we have is, are there any alternatives to property if an investor wants to use gearing?
I'll answer that one. Not a lot. So I guess, you've got investing in businesses, but then you've got potentially quite a high risk. I've certainly had a lot of clients and other friends who invested in businesses over the years to quite varying levels of success. So that's one option. You can gear into the share market, but at a much lower gearing level. And again, there's that volatility there. One of the advantages of gearing into a property investment is you've got the tenant paying a rent, which offsets what you're paying on your lending. But you don't get that necessarily you may get some dividends in the share market, but not to the same level. So much harder to gear into the share market and at much lower levels, which is unlike Australia. Like Australia's got a lot more flexibility. I've got a number of friends over there who have quite large mortgages and have got what they would normally have been paid off on their mortgage into quite a diversified portfolio that then when they retire, they sell their portfolio, pay off their mortgage, and hopefully there's a big gap between the two. So limited, options in New Zealand. I don't know whether you guys, Jean or Pete, you've got anything to add to that.
No, not really.
Okay, super. Yep. So the next question is probably for Pete. So we saw REITs suffered during the COVID sell-off last year, which Jean has showed us on her slide with Kiwi Property Trust. Now, AP&A REITs, have you made any changes to the composition of the fund, given we are not completely out of the woods yet and the slow rollout of vaccination program?
Yeah, that's a good question. And yeah, we did. Kiwi's probably an example of a stock that was kind of really in the hitting zone for impact of COVID. Owns office and work from home. Lockdown was a big factor. And then it owns a lot of really high quality retail, which is discretionary focused. So of course that was an essential service either. So those ones have been affected to a similar magnitude in Australia, but there was a bunch of others that whilst the market didn't know how to comprehend what a global pandemic could bring, and hence there was a massive overreaction. Not every stock was hit the same way. So you look at some of the industrial landlords, as I said, some of the core like their service stations and the like, they did really well. So I feel there's that underpins those stocks. Can we go back? Sorry, can we go back to the question? I think I might have gone off on a bit of a tangent there.
Have you made any changes to
and with regards, yeah, that's right, in the portfolio. So what we did really had a good hard look very early on, because we've got an Asian and global funds, and we could see trends presenting quite early. So clearly the malls, we had exposure to a couple of hotel REITs in Asia and the US. They were gone. Mortgage REITs were gone. Malls we could toss out of the global and Asian fund. We couldn't to the same magnitude, but we downweighted to underweight in likes of Centre Group, which owns Westfield. But we felt that not all retail was going to be bad, because clearly everyone was shopping at your local neighbourhood shopping centres, and they did really well. Supermarkets went gangbusters, to tell the truth. And so we weighted the portfolio, downweighted retail, but the retail we retained was primarily focused on non-discretionary spend, convenience type assets. So that actually performed pretty solidly, and the cash flows came back really strongly, and were least impacted by the leasing code of conduct that was imposed in Australia. Office, it's we took a skew to more metropolitan office as opposed to CBD, and we still have that today. We sort of feel that those types of assets are probably a little bit more robust. Over here, they're really high quality, the ones we have, a lot of government tenants in there and high corporates. So that's done quite well. And then the non-core types of exposures, and clearly the other one was industrial. We've really upweighted our industrial exposure because everything, for a point in time, so much went online, and there's so much further growth to come through as well in that sector. So it costs you more to buy an industrial asset now than it does to buy a shopping centre based on the cap rates.
Can I just add a comment, sort of following on from that, is I think is what a lot of people don't realise is that how proactive fund managers actually are when they're managing portfolios. And often, by the time, us as Joe Public realise that something's actually happening, we think, oh, we might need to make a change to something. The fund managers have been onto it 3, 4, 5, 6 months beforehand in some cases. And, I've had a lot of clients, a lot of friends who have invested directly into commercial property syndicates, and their views often are, some of them I know have sort of 4, 6, 8 of them, and they've said, look, yeah, some of them have been fantastic and some of them have been absolutely bloody diabolical, but overall it's kind of been fairly average. And so, but you've got no liquidity, like Jean was mentioning before with those investments, whereas you start going into REITs, you've got that flexibility, you've got that proactiveness that, we often don't get to do because we're too late, and so I think it really shows some real benefits of the REITs over and above the direct commercial investors for passive investors. If you're an active investor and you can buy well, add value, change use, all those sorts of things, then you can do well. But the average investor doesn't have the skills and the knowledge or the time to be able to invest like that.
The other, I would agree with that. And the other thing is with a black swan event, you always get an overreaction. And, we've just come off the end of our financial year to June. So REITs returned about 33% versus the equities at 27%. So a lot of the underperformance that was there in FY20 because they were hit so hard, the reality is people are realising that the cash flows are pretty robust, asset values aren't falling, there's really strong demand on the transactional market. So things, it was an overreaction, and why wouldn't it have been? Who knows how things were going to play out, and it's still not completely clear where the recovery is going to come. But the reality is we are going back to more normal. We're not there yet, but we're getting there, and hence that overreaction was a huge opportunity for anyone that was brave enough, and was great for those that stuck at it because they pretty much received a pretty high level of income going through the whole process. There's a few stock distributions for a quarter or the half, but they're all switched back on.
Super. This is probably a follow-up question for you, Pete. So there are some specialised REITs out there in childcare or storage unit, that kind of stuff. Do you include those in your funds?
Yeah, we do. Childcare, I think leading into COVID, we were probably marginally underweight. We felt it was a little bit overpriced, and the barriers to entry are quite low there. That's the thing. That's where retail still has the highest barriers to entry, which is a level of protection. But, as soon as the government stood behind childcare with a very significant stimulus package through COVID, we felt that was great for those that asset class, and so we're overweight that in the portfolio now. Similar with service stations, we were probably close to market weight going into COVID, and now we're probably nearly 3 times over. We're getting a 6% distribution yield from that asset class. We're getting capital growth. Last year was a record level of transactions in that sector. It's just becoming more institutionalised, and we think there's great stability and income, but capital growth as well. Pubs have done well. You might, it's clearly pub being shut down isn't good, but a lot of them had their bottle stores open. So because of that, they had a cash flow, so they were able to pay rent, and some of them did very well through COVID, through their bottle shops and that type of thing.
Yeah. Whenever there is a crisis, it does present opportunities as well, doesn't it?
It does.
So the next question is probably more general out to all the panel speakers. So the dirty word inflation is returning. So with the prospect of rising interest rate, what would be the impact on REITs or property market in general?
Perhaps I'll start with REITs. As I said, a lot of the leases are linked to inflation, so it's an asset class that has perhaps one of the higher levels of inflation protection. Usually, low interest rates are great for REITs because they're paying out less for debt costs. Debt management has been a major focus since the GFC for REITs. I'd say they're best in class in Australia. The debt average gearing is sub 30%, so pretty low. The tenure of the debt is greater than 5 years. Average interest rate is probably in the 2 to 3% band. So say interest rates go up 3% tomorrow, well, because of the 5-year tenure, only 20% of that debt profile will be refinanced this year. That'll be exposed for that. So as it was on the way down, it's incrementally a benefit to the cash flow. But if interest rates are going up that much, it means we've got a lot of growth in the economy. It means things are going well, businesses are going well. They're probably going to be able to have higher occupancy rates in assets and charge higher rents. So it's kind of, you get this initial reaction in our sector when bond rates turn up, and we saw it in January, February into March this year. And then there's the realisation that, hang on, this isn't all bad for REITs, and people will come back into the sector.
Yep. And Lisa and Jean, do you have anything to add?
Yeah, I think for residential property investors, it's going to be a bit of carnage, I would think, because when interest rates were 6% and they went up to 7% without doing the numbers, interest rates went up 15%. When they're at 2.2, 2.3, and they go up to 3.5%, they've gone up 50%. So that has a significant impact, because if you're paying $20,000 a year of interest on a property, suddenly now you're paying $30,000 of interest, and you've got to earn $15,000 before tax to pay that extra $10,000. So I think the impact is going to be significant. The other thing is, unlike commercial, residential investors, the vast majority of them are on 1-year rates. So, they will feel those impacts quite quickly. And I think, my view would be that if interest rates, and they will go up, it's just a matter of when and how much, then, that will probably slow down the market, because there'll be a lot of people struggling that really haven't kind of, they've said, oh, well, it's going from 2.5 to 3, but they haven't actually worked out what the dollars of that actually mean. And for those with a couple of properties, and I think the other thing that the media sometimes gives everyone landlords a bit of a hard time, but what they don't realise is something like 91% of property investors in New Zealand only have one property, and for most of those people, it's kind of they're only just managing to match the cash flow on that property. So interest rates, I think, will have a significant impact on residential investing, and I think my only advice there would be is to consider potentially locking in some longer term interest rates and hedging some of your interest rate profile, and the other side of it is to stop buying too much stuff, which may not be so great for the retailers out there, but start paying down that debt on your mortgages to again protect you against future rises.
Yeah, I think you're absolutely right, Lisa. And in fact, those long-term fixed rates are already moving up. That they were 2.99 for 5 years towards the end of last year, and now they're in the mid-3s. And I think not only will it have an impact on residential property investors, just a 1% increase in interest rates will actually suck a lot of money out of the economy as a whole, because people will be paying interest costs instead of shopping. So yeah, I think you're right. We could see some big repricing, but it also, I think, feeds into that story of diversification. And New Zealand is such a small economy, and that's why I like the fact that we can invest in Australian listed property, where again, it's a bigger market, and we can go beyond Australia to global property.
Yep. That's some sound advice. Thank you all. We've got the last question. It's probably for Pete. Pete, you're getting a lot of love from our audience. The question is, what are the fees associated with the fund?
Yeah, sure. The fees are 85 basis points or 0.85% per annum. So there's a buy-sell spread on the unit price, but that's 0.2 of a cent, I think it is. So it's pretty minimal on that side. And as I pointed out, it's full liquidity, monthly distribution. So for people looking for pretty regular cash flow, like our style is different from a lot of our peers. We're focused on delivering income to investors. So hence the 5.6 yield. The yield out of the index is lower than that. So if you go into an index product, you'll get a lower yield coming through. Our focus is on the yield side and lower risk than the market. REITs are less volatile than the broader market. They took a bit of a kick in the shins last year and underperformed the broader market, but it was a COVID global pandemic. Hopefully, I think we'll get a period of sustained returns from our sector where they're underpinned by the solid cash flows and some really good growth coming through different parts of the market. I'm really excited about the non-core sectors that I've discussed. I think there's a real opportunity there.
Fantastic. Thank you. Now we've answered the last question. It's 10 minutes to noon, and we must have done a fantastic job. Our audience don't actually have that many questions for us. So we've come to the end of the hour together. I hope you do find today's session helpful. It is a tough environment for investors who is trying to win the race against inflation and achieve real capital growth when the interest rate is at historical low level and government policies are not exactly supportive. I hope the content we shared today give you some new ideas and broaden your investment horizon. Now the slides and recording will be circulated. If you have any questions for our panel speakers, I've got their details in front of you and feel free to get in touch. Now, as a token of appreciation to today's attendees, Saturn Advice will offer 30 minutes free consultation to you. If you're looking for a sounding board, if you're looking for a bit of unbiased guidance around how to make the most of your hard-earned money, a short survey will be emailed to you after the webinar ended. If you want to take up the offer, please pop your details in there. I will get in touch. On behalf of the team, I would like to thank all our panel speakers and thank the attendees for being here today. This now concludes our webinar. Thank you. Bye.